thinks of is your monthly cost of what the lender is giving you, what the lender is telling you. And that number is basically four things. It is your principal, your interest, your insurance, and your taxes. So again, if you were to buy a house cash, you wouldn't be required to have insurance. You're required to have insurance because you have a partnership with a lender, a mortgage company, and that bank is requiring you to have insurance on your property. You can shop around who insures it, but you need to have insurance. Taxes are something, this is the big one, and I did another video on it, but it's one of the big things that I want you to pay attention to, because just because your taxes are $2,000 right now on the property does not mean next year they're not going to be 10 or 12,000. Even if it's 6, it can very quickly change your affordability. So it's just one of the main things. Two of the things that really won't change a whole lot are your interest. You're going to lock that in, and your principal. So unless you do a big chunk payment to knock down what your principal balance is, your 15 or your 30-year loan, those two are going to stay stagnant. They're going to stay, which is good. There, unless you get a fixed, like an ARM and a 7-year loan, most people do a 30-year fixed rate. 30-year fixed rate means that your principal and your interest payment are going to stay the same. The other two are the two that could potentially change. And I did do a whole video on this earlier. I will link it down below.